Hey guys, welcome back. In this video, we are talking about the short squeeze happening, how there's no more liquidity, the short loophole, and many more in this video. First, we're taking a look at this. The fact that AMC is trading routinely around 80% off exchange is incomprehensible. What we're looking at is once again 78% for AMC, 22.8 million volume being hidden away. So we've talked about this for the last week, especially we had a very big focus on the dark pool for AMC because every day we're seeing it above 70%. And for most days, we're seeing it above 75%. And even on some days, we're seeing it at 80% plus. Now that itself is obviously very abnormal because when you take a look at all the average dark pool usage for the normal stock market, you're seeing it at way below 70%. You're looking at going from 20 to 40, but nowhere near the 78% that we are looking at now. Even the 30-day average that we're looking at is still 65.63, so it's still above the market average. And more importantly, you're looking at how the NYSE recently are, of course, at a low percentage. So this itself is already showing us the soft manipulation and suppression that's going on in the market, and why it further highlights we are not seeing the true price of AMC. You have to realize AMC went up 4.33% today. But that's done with the fact that we are seeing so much volume still being hidden away. And so you can only imagine how much AMC will go when it's not being suppressed. If we're able to even see the average dark pool usage on AMC, and I'm talking about the dark pool that we're seeing for all of these other stocks that's applied on AMC, you're going to be seeing how AMC will be experiencing massive price increases because then it's actually showing that the majority of the orders are buy orders and they're willing to accumulate and not selling any shares of AMC. You can even see another problem right now. Firstly, like the repo market in September 2019, but there are no Fed liquidity tools for private credit markets. What this is referring to is you can see Bank of America warns of forced stock selling if credit problem persists. And so we've highlighted multiple problems recently in terms of what could be causing a massive sale, a fire sale, what could be causing a massive collateral to be failing. And so this ranges from so many different sectors that we've talked about, whether you're looking at the AI bubbles, whether you're looking at the commercial real estate, or in this case, the credit problems. There are so many different areas where it's showing signs of corruptions, is showing signs of collapsing of the market. And so this is something that we've talked about with how it could massively affect the collaterals, how it can massively affect the market. The reason why it's relating with AMC is that you have to understand, if we're going to be seeing institutions being massively affected, so they're going to be seeing massive reds, massive losses in their books because of fire sales, because of collaterals failing, then you're going to be seeing how shorts will be finding it difficult to continuously suppressing AMC because they rely on these collaterals. But if these collaterals value were to go down, then they won't be able to use it anymore to obviously suppress AMC. And so that's why we focus on it. You can even see here, starting off the day by borrowing $3 billion from the lenders of last resort has got to be rough for those GME shorts. Over 20 billion borrowed in the past 5 business days. So we've talked about this in terms of about how these capitals are being used for these firms to finance their positions, to continuously make their positions or make their books look healthy. We've already shown how a company that went bankrupt recently relied on these capital. And so when you do see the numbers going up, when you do see that companies are borrowing more and more money, you have to realize is that it's because they're struggling with their positions. We tend to see that companies who are either seeing liquidity problems, who are seeing some of their positions going wrong and are in need of money to be borrowing from the repo. And so when we're seeing this number go up, or when we see this number fluctuate, it's obviously showing how there is desperation from the short selling side. Now, in terms of about the loophole, one of the things we cover on this channel is obviously about the ETFs. And one of the big reasons why we cover it is because we've talked about how these ETFs are used as a way of locating shares of AMC and GME. But another reason is that obviously you can see here, it allows FTDs to be satisfied with the creation of an ETF. Now, we should know by now is that shorts obviously use different strategies to try and find ways to suppress and manipulate AMC and GME, whether it's with options, whether it's with tokens, whether it's with ETF. You can see that in this case with ETFs, it obviously allows them to satisfy the need of FTDs. We've seen it used as a way of locating, like we've talked about in the past. And so you can understand, what these are used for. And so this is literally looking at the, the understanding of it. And so when you see us talking about, these ETFs, or whether it's the XRT or any others, it's because they're using it as a way of locating shares of AMC and GME to try and obviously short it. You can see it's legal for market makers to infinitely naked short a stock, plus all major institutions are market makers. Equals is legal for all major institutions to infinitely naked short a stock. Now, the reason why this is obviously being said is because clearly regulations have turned a blind eye towards these kind of behavior. And we've seen how plenty of institutions have jumped on in terms of naked shorting different stocks. And we obviously know that AMC and GME is experiencing the most of it. Now, one thing I want to make clear is that just because the regulations turn a blind eye towards it, it doesn't mean that what they're doing wouldn't go against them. And what I mean by that is that, because there is no regulations right now, it's allowed them to get away for the time being, creating these naked short. But you have to understand that these naked short all carry a cost. They don't just go away. The only way for these naked shorts to go away is either for the company to go bankrupt, or for that company to be 100% owned by institutions who then won't chase up on these shorts. And we've talked about why that's obviously not possible, because firstly, we're not seeing any signs of bankruptcy from AMC or GME. Secondly, we're not seeing any possibilities of the apes leaving AMC or GME. And so in this case, they can hide the naked short, they can delay the naked short, but it doesn't stop it from being existing. And so it will come to a point where these positions get too toxic, they run out of money and will be forced to cover, like we have seen in the past. And recently what we're looking at is obviously why shorts are potentially lacking in collateral, why we're seeing the volatility in the market. It's because with Beyond Meat, BYND, now, some interesting things about this is that you can see why zero holds for BYND are 750 million in volume and up another 60% and able to trade to a normal 2 decimal places instead of 4. AMC holds it 20 times and traded to 4 decimal places. Now, this isn't me attacking Beyond Meat in any means whatsoever. But it's about talking how potentially we're seeing that whilst the Beyond Meat may also be experiencing a short squeeze because of his short interest, we will talk about it later on, but it doesn't have the effect the short sellers like AMC and GME would. And it is just interesting to see that there are companies out there who are able to go, and currently Beyond Meat is sitting around a similar market cap, and in fact after hours it could potentially be even higher to that of AMC. And so at a similar market cap, when Beyond Meat is able to go up 100%, 150%, it doesn't experience any holds, but AMC does. And it truly just shows what's going on behind the scenes for AMC and GME. And it truly just shows how big the situation obviously is. Now, one thing I want to make clear as well, that in terms of my opinion, but you can also see Kristen says it here, be careful of the media narratives. The reporters will say BYND is a retail short squeeze. What retail investors will buy 100 million shares of stock before 8 a.m.? Only $100 million. So let's quickly break down into this. Firstly, it's not, there isn't to say that there is no influence of retail. Retail have, of course, bought into BYND. And this is something that we should be known. However, we have to understand is that this is different from the AMC and GME situation, because this wasn't started by retail. This was started by, we can see here, 100 million shares being bought of BYND when they were below $1 billion in market cap. So that's over 10% of their shares, of their current market cap. And so this is what obviously started it, and then with the momentum it came in. And so we're going to be seeing how media will try to say that this is the retail short squeeze. This is without doubt a short squeeze, but it's not the retail short squeeze. And the reason why we're going to be seeing the focus on that is because they obviously want people to sell the AMC shares and buy into BYND. And so this isn't me telling you to not, to stay away from BYND. If you see it as an opportunity, if you're able to make, something out of this, feel free to do so, go ahead, right? But it's about understanding the difference between BYND and AMC and GME. And it's about the impact that this has on shorts versus the impact that AMC and GME has on shorts, because we've seen it with the fact that it's not experiencing any halt. And you can even see, we're seeing how Reddit stock tweet starts banning retail investors that mentions BYND, and the fact that Robinhood is down, not allowing retail to acquire BYND shares, which has changed, but we may be seeing some news of that later on as well. And then you can see once again how Robinhood is still down, not letting retail acquire shares. And then what we're looking at is the fact that Bank of America says that worries of recessions have fallen to the lowest point since February 2022, while optimism about growth has surged. However, you can see here, meanwhile, UBS puts the recession probability at 93%. And so, this is what we've said with how these institutions, they all just have a mind of their own. They all give different opinions. And so do not just take their word and believe 100% of it. Make sure you do your own diligence. It's something that I always say. But typically when you see this, you can see the difference in the two. Firstly, UBS puts the recession probability at 93. No surprise, especially with how heavily affiliated they are with AMC and GME swaps. Bank of America, whilst they say this, we obviously started the video off with saying how they also warned of forced stock selling. And so you can see how different situations have different perspectives, and you have to understand what's going on. Now, as always, this is financial advice, so do take what I say, so make sure to do your own due diligence and research, and I'll catch you guys next time.